Just a quick intro to everybody. Hi, I'm Abby De Molina. Nice to meet you. I'm a finance manager at Santander Bank, but I got involved in doing financial literacy classes through the state of Massachusetts in the Women's Economic Empowerment Forum. So I started becoming a part of financial literacy through that, and the curriculum that we're working on is actually through the FDIC, the Federal Deposit Insurance Corporation. So Janet has any of the links. There are some workbooks, other additional information if you need it at any time you want to go back, review. There are sometimes examples and there are some worksheets. So you would be able to get any of that information through their website. And I believe she either has sent out the link or she'll send it out in a little bit. And she just put her email out on the chat. And please feel free, I want this to be interactive. So if you have any questions, feel free to put them in the chat. And if you want me to stop, or feel free to unmute yourself and just kind of jump in if there's some area you want me to focus on. So I know there's a lot of information, but we can stop at any time if you have questions or if there's anything you want to go through. So just keep me posted on anything you want to focus on.
Okay, I'll go ahead and share the PowerPoint. Here we are.
Great.
Yeah.
So as I mentioned, this is week 2. The first week was more just basics about banking, making sure people understand how to bank, any basic questions about banking. I know it is recorded. If you feel like you wanted to go back and get a refresher, you can always go back and find it. You can always ask me any questions, but we were just talking about basics with banking, setting things up, any financial kind of basic questions. We covered a lot of that in the first one. And this week, what we're focusing on is credit and borrowing. And then next week, we're going to talk a little bit about debt, and then we're also going to talk about housing and purchasing a home and going through that. So that's our kind of 3-week curriculum. And as I said, all these are recorded. So if you happen to miss a week or there's something you want to go back and review, you can always go and find them. So the module, so we're picking up the modules that we're going to go through is credit reports, borrowing basics, using credit cards, building your financial future, and then protecting your identity and other assets. So module 6 picks up in, as I mentioned, these modules are through the FDIC, so we use it as a basis, but of course we can kind of at any time go away from the track, but they're just the basic framework for this. So this is just helping people understand what credit reports are and their scores. Your credit history obviously is really important. It helps you anytime you need to borrow money, access any credit loans, when you apply for a job, your credit score will be run, and other services. So understanding your rights, a lot of people don't know necessarily all of their rights related to a credit report and your credit history and what you can do to protect yourself and also make sure that your information is as accurate as possible. So what's listed in your credit report is your basic identifying information, your debts, and then some bills, anything that's a public record, and any time you have an application for new credit or other inquiries. So this is if you apply for a job, anytime if you're applying for a credit card, those will show up as inquiries against your credit. If you are renting somewhere, they might look at it. So any of those things will show up in your credit report, as there's called kind of soft and hard checks. So a soft one is just someone will look to look at your general credit worthiness, and a hard one is someone actually pulls your credit report. And so financial institutions, I have a list all here, landlords, utility companies, some cell phone, insurance companies, employers, and some state agencies. These are all people who would use your credit score and run it. And what your credit score is it's a number based on all the information in these reports, and it predicts the payment of bills and debts as agreed. And people obviously with higher scores are less likely to be a risky investment for creditors. And so I have listed here, there are 3 main nationwide reporting agencies, Equifax, Experian, and TransUnion. And so those are the three. Your score is going to be slightly different with each of them, but those are the main three that you will get all of your credit information is through those guys. So consequently, if there's anything you need to do to update or change it, you would be going through them. And risk-based pricing is what we're talking about when how lenders will determine what kind of financing they're going to give you. This might be if you get, let's say, credit card offers. They'll be based on your credit history, and they'll set interest rates and other terms based on these risks. So if this happens, by law, whoever the lender is, they have to tell you they use your credit report or credit scores to deny your application or offer you less favorable terms, and they have to do this in writing. And these are the two things I mentioned, the adverse action notices and risk-based pricing notices. So they have to be very clear that that's how they decided either they weren't going to give you credit or this is the type of credit that you're offered. So what happens if you have no credit report or scores? You're known as what's called credit invisible, and usually it makes it harder for you to get credit or a loan, renting an apartment, getting a good cell phone plan, some jobs, and also if you need to turn on utilities, if you don't have any credit, they might require some sort of large cash deposit from you. So those are just a couple of examples. And another thing that's important to know is often people receive these pre-screened, I know people know what I'm talking about, where you get these pre-screened offers for credit or insurance. You can opt out of them at any time. And you can, what I was saying is that you can do this thing called opting out. So you can opt out of receiving these pre-screened credit offers for credit cards or insurance. You can do it for 5 years. You can do it permanently. Sometimes people might get overwhelmed with a lot of these, and they also might be tempting because you might see all these things for credit cards. So that's what is important. You can opt out. You can still get offers from other lists and other sources. And anytime you opt out, you can obviously opt back in. But the thing you cannot opt out of is actually having a credit report. So that's not something you can opt in and out of, but you can opt in and out of getting those types of offers. So in terms of your credit score, there's a lot of ways that you can improve and manage your score. Obviously, paying your bills on time is one way. And other ways you can do it, if you understand the basics of your credit score, you can, next one.
Oh, there you go.
Yep. So you can pay your bills on time as agreed. The number is calculated from all the information in your credit reports. As I said, the higher number usually means a better credit history. It predicts the likelihood of you paying. The two really important factors for credit scores are whether you repay on time and as agreed, and then your credit utilization rate. So this is if you happen to get, 5 credit cards, but you never use them, that would also, that would affect your credit, or at the same time you get 5 credit cards and they're all used completely. Both ways, that's going to show up on your credit report. And as I said, you're likely to have multiple scores because there are different organizations that score them, and there are different models depending on the different types of credit. And so this example here is showing the FICO model, which is really common. And so it shows your payment history is 35%, the amount that you owe is 30%, the length of your credit history is 15%, the credit mix of different types of credit is 10%, and then 10% is how much new credit. So it's just an example so you can understand, everybody's a little different, but they take these general factors into account.
Abby, what does new credit and credit mix mean? What would be in there?
So new credit would be if you're always applying, let's say you keep applying for new credit cards, And like, so very recent credit, that's what would be counted as new credit. So what they're looking at is obviously if somebody's just like applying for credit cards, using them up, then applying for new ones and using them up, then that's where that would affect your credit score. And then credit mix is the same thing of if you just have a bunch of credit cards and you didn't have any student loan debt, or if you have a mix of different types of loans, like you might have a car, a mortgage, those different things, those are all what goes into the credit mix. So again, it's just making sure that, or what would help you improve your credit score is to have a diverse mix and not just one thing. And also at the same time, you don't just want all these things where you're like maxing out your credit cards, all these things where you owe a lot of money. There are also, if you have good things like that you're paying everything off, that you might have different kinds of like bank accounts, different things, all of those help your credit. So the more like diverse and safer mix, the better, or just it helps your score improve. Okay, next slide is, so as I say, you can order your scores. The thing you should understand is they might not be who's used, and if you're turned down for credit, you do have the right to see the exact score used. And what you should do yourself is make sure that your credit scores accurately reflect the information in your credit report. So you should make sure to get and review your credit reports and dispute errors. And I have this little table on the right-hand side. This is by no means like end-all be-all. It's just kind of a general guidance of, if you look, exceptional credit is usually anything over 800. Very good is 740 to 800. Good, 670 to 740. Fair is 580 to 670. And then poor is usually anything under 580. Again, this isn't hard and fast, but these are just kind of general guidelines. So what you should do though, every year, every 12 months, is make sure you get a copy of your credit report and you review it to ensure that all the information is accurate. And what a lot of people don't know is that you do have a right to free credit reports. And you have a right to one free credit report every 12 months from each of the 3 agencies, as I mentioned, Equifax, Experian, and TransUnion. And the website you go to is annualcreditreport.com. And it's an official website, and that's how they process the orders. The thing that you should make sure to watch out for, and we mentioned this a little bit last week, is there's a lot of imposters or places that offer or advertise free credit reports, credit scores, credit monitoring, but they're not actually part of the legally mandated free annual credit report program. And what they do is they offer free services to you that you usually have to end up paying after a certain trial period. And so that's why I want people to understand that legally, you can always get every 12 months your credit report. So you really shouldn't sign up for anything, and anywhere anyone asks you to pay, you should not pay, because you can always get it for free at annualcreditreport.com. Are there any questions?
Did I move too fast? Oh, here we go.
No, I think you're good. So as I said, there are a couple of other reasons you can get additional free credit reports. If you're going to receive public assistance, if you're unemployed and looking for a job, if, of course, you're a victim of an identity theft or financial fraud, and your state law might provide for a free credit report. And anytime you're obviously denied credit, service, and apartment or employment, you are, again, entitled to find out this information. So what's in your credit report is, again, all of your personal identifying information, public records, any accounts that are assigned or sold, any credit accounts, and any inquiries. As I said, if anyone's looking into your credit, you'll be able to see that to know that someone's checking your credit. And who would be getting your credit scores are some nonprofit organizations, some credit cards offer them, or websites that show you when you have a right to score. I know I have a credit card that gives it to me every quarter, I want to say, but it's not like a full report, but you can often get it through your financial organization. And also you can get them through My FICO, Vantage Score, and then again, the three main credit score organizations as well.
Can I ask a question? How long?
Yes, you can.
Take? Yeah. How long does it take when you apply before they get back to you? Is it weeks or is it days or how long?
So if someone's checking your credit, or if they're actually going to give you or to get a copy of the report?
No, if I apply for my credit score, how long would it take to come through?
Oh, these days you can get it pretty instantaneously. So, so example is if you're like applying for a credit card, they can check it over the phone and see right away. So it's usually instantaneous. To get a copy of it, I believe if you go to any of the websites, you can download your credit score. And again, it's like you can download your credit report and it's available. So it's not like a long process. The part that might take a long time though is if, and kind of getting into this piece, if you have to dispute anything, usually that might take a bit of time. So that's the one piece. But
so
yeah, actually checking your credit and getting your score, it shouldn't take a long time.
Okay, so if I went to annualcreditreport.com and gave them what was necessary, if they asked me questions online, then it would almost be instantaneous that they would give me the score.
Right. You should be able to download it and find out your information. It shouldn't take a long time.
Okay, wonderful. Thank you.
You're welcome. So this section is, if you find any errors in your credit report, what you need to do is make sure you file a dispute right away. You should keep records and obviously follow up what kind of errors you can find: identity errors, incorrect reporting, data management, balance errors, information's outdated. This is important. What I mentioned last week is sometimes if you have a name that's similar to somebody else, you might have relatives. Sometimes these things do get mixed up. So that's why it's really important to check your credit report and make sure everything on it is truly yours and that the information is correct. It does happen. I've seen instances where someone who has a really similar name, it might have somebody else's information. Of course, if you're a victim of identity theft, those type of things will show up. So it's really important to keep an eye on it. And especially because anytime there's negative information and it's not yours, you want to make sure that you remove it. That being said, you might have negative information. Something might have happened in your past. Those types of things can only be reported on a credit report for 7 years. There are some types of bankruptcies that are an exception, but generally this could be if you didn't pay a bill, something like that. It usually will eventually kind of cycle off of your credit report. That being said, for negative information, when you're applying for a job or a certain amount of credit, such as a mortgage or life insurance, those negative things will still show up. And I know this 7-year rule can be a little confusing. It generally starts 6 months after you stop paying the debt. So I have a little example here where let's say you had a bill that was due in July and you're 30 days late starting in August. So this is where I know your delinquency starts, but the counting begins the prior month in July. So if your bill was due July 15th, that's the date that they start counting those 180 days. By November, you're 120 days late and the creditor closes the account. So it shows that by January 2019, that's when you're at that 180 days. So after January 2019, you have to wait those 7 years, and that's not going to be until January 2026. So that's when this negative action would no longer show up on your credit score. So it's quite a long time, which is why you should always make sure to pay what you can, because it does stay on there for a pretty long time.
Abby, there's a question from Tatiana. It says, question about time limits for negative info. Oh, sorry. You might have answered, but did you clarify? Was that clarified for you, Tatiana?
No, actually, so my question would be, with a job with a yearly salary of 75,000 or more, if you're going for a job, they can see all of your negative information beyond or before 7 years? Is that what you're saying?
Yes, so it wouldn't necessarily, they can see, like if you had, let's say you hadn't paid an account 15 years ago, they would see it.
So is there any way when I pull my credit report, I could pull a report that one of those people might be able to see?
Well, when you pull your credit report, you'll see it for yourself. And so you would be able to see what they would see.
Even if
that makes sense.
Even if it's 15 years ago.
You as yourself, you should be able to see it. Yes.
Huh. Okay. Okay. Thanks.
Yeah. Yeah, you're welcome. I mean, I do think, especially with like employers and things like that, it's not, I mean, I think that if you had something from say like 20 years ago, I don't know if an employer is going to be like, well, you didn't pay that bill from, 2000, that they won't hire you. But I can't speak for sure, but I think that there is some, with employers, like there's some leeway to talk about it, at least like explain what might have happened in those types of situations where it is old information. So I don't think it's necessarily.
Yeah, I guess that's why my question, because if I don't know it's there, do you know what I mean? Like if I'm not seeing all the transparency on my own report, then I wouldn't even know to get ahead of it.
Right.
Yeah. Okay.
I know from a background check standpoint, like something like that wouldn't knock you off, if you know what I mean.
Yeah. Yeah.
So, but it's a good point that obviously you should be able to see it. But I would agree that obviously if you couldn't see it, then there's like, how could you explain to them what happened?
Yeah, it's a fairness issue. Okay. Yeah.
Yeah.
All right. Totally hypothetical. My credit is awesome. Kidding, but yeah. All right.
No, and also I think sometimes people just don't even think about it. And I know someone who I talked about, like it's somebody, him and his father have like a very similar name, and he just happened to check it and saw that like something from his dad that was adversely affecting his credit. And he was like, it's not even me. So those types of situations do happen. And it's like, if you didn't look at it, you wouldn't even know that that is something that's on there. So it definitely does happen for sure. So always good to just check. One of the things though to talk about, medical debt is something a little different. It's not necessarily on credit reports unless it's been unpaid for at least 6 months. So this does provide more leeway for resolving billing disputes, making payments and payment arrangements. And again, the way you dispute errors in your credit report is online or in the mail, and you usually have to write a dispute letter. We do have examples of letters, and I think we had a link that I'll have Janet send out, but you just have to make sure you provide obviously all of your identifying information, clear description of each item you're trying to dispute and the reason, and an official request for a correction or removal, and including supporting documentation, copies, not originals, obviously, receipts, any account statements, credit cards, image of a check, or screenshot of online transactions or bill payments. And what you should also make sure is anytime you obviously file a dispute, the reporting agency should send you a letter or somehow acknowledge your communication. And it says incorrect information cannot be put back on your credit report, so you should double check to make sure. And you can also request that if you do make a correction, that those notices of those corrections are sent to individuals or businesses that had received your report. So an example could be if you had an employer, they ran your credit, you found an error, you saw that, and then you went and corrected it, you could then go back to that employer and say, hey, just so you know, I resolved this, this was an issue, and they'll get an updated copy of your credit report.
Sorry. There we go.
No, it's okay. So that being said, there are also ways for you to build and repair and maintain a productive credit history. I think you have to go back one, Janet. Maybe.
Hold on one second. Sorry. My PowerPoint's not great, I think. There we go. Is that the right one?
Okay. Yes. Okay. So your credit history doesn't have to be your credit future. You can repair and improve your credit. These are a couple of examples. Obviously, reviewing your credit report, disputing and correcting it, paying all your bills on time, using as little of your credit limit as possible, using and creating a credit building strategy, and then keeping old accounts open even if you don't use them. That's really good to have on your credit. An example is I have an account that I think I got when I was in high school. I don't use it, but it's just something because it's so long standing. It's good to have things like that if you're looking to improve your credit. Obviously, only applying for credit when you need it, seeing if you can negotiate different or better terms, and then asking for a goodwill deletion, which means if you have, you know, in good faith paid off something, you can always get it deleted off. And other ways you can build credit is obviously through secured credit card, a credit building loan, becoming an authorized user on an account or a co-signer, applying for a credit card at a store or a gas station, or obviously making a large down payment or negotiating a loan for a balance. So, you know, if you happen to have extra cash, anytime you use that to pay down your credit, it will give you a little boost on your credit report. And another option you can do is kind of build this alternative credit history by tracking everything you pay on time. You might have stuff that is more unofficial that wouldn't necessarily show up on your credit card if it's rent, childcare, cell phone bill, electric, gas bill, water, sewage, garbage, TV, internet, insurance, any loans, savings, any of that stuff. It might not, like some of this could be on your credit report if it's your utilities, things like that, but some of these things might not. And so if you do track it and have proof that like, hey, you've been paying these things on time, that's also something you can use to kind of prove your positive credit history.
Abby, I have kind of a funny story. I mean, this was years and years ago, but my parents, when they were newly married, I think, oh no, maybe, yeah, all three of us were really little, my sisters and I, and they wanted to buy a house. And one of the things that got them credit, because they didn't really have any credit, was my dad was working part-time at Sears at the time, and he bought a stereo and he paid for it in advance, but he arranged for them to take payments out so that so it was all prepaid from an account, but they took payments out. So it was him paying down this quote unquote debt. And that was how they helped build up their credit so they could get the first mortgage for their house.
Yeah, no, it's a great example because a lot of times when, you know, you're young and you're just starting out, you won't have a lot of examples. And so when I talk with people, even if it's just something as simple as like doing the cell phone, it doesn't have to be anything big, but even if it just shows, hey, you're paying your, you know, $16 a month for your like iPhone or whatever, those are technically loans. So it is going to build up credit for you. So it can be anything like that. Or even on here, we talk about like a loan from a friend or a family member. I mean, it sounds like the employer luckily did that, but yeah, anytime you can do any sort of little payment, it does help you. So thank you. Good example. And nothing's too small. So that being said, make sure that you also continue to maintain credit by paying your bills on time, paying down your debt balances, keeping the proportion of credit you use low compared to credit limits, obviously not applying for too much credit, or avoiding actions or inactions that can create new entries, obviously paying your taxes and child support in full and on time, checking your credit reports and disputing errors, and then just in general, keeping good financial records. But that being said, you might need help. There are a lot of ways you can get help through a financial institution, any sort of bank, credit union, any organization like that. A non-profit consumer credit counseling service can help. The housing counseling agency approved by the HUD, any financial education nonprofit, certified financial planners, any other organization, they can all help you. There are also some credit repair and debt consolidation companies. They'll promise to fix your credit for a fee, or with debt consolidation, they'll use different services, and they specialize in different types of loans for debt consolidation, debt settlement. I would use caution with these options, because with debt consolidation, you might just end up taking out a new loan to pay off the other debt, but you're not actually addressing the issue, which is the fact that you needed the money to begin with. And then with debt settlement, you're gonna have to work with creditors to accept a lower payment and settle debt. And you might end up having to pay income tax on a portion that you settle. So let's say you owed $10,000 and you end up settling it for $2,000, you still might have to pay taxes on the $10,000. So it is something you need to keep in mind. A lot of times people forget about stuff like that. But so it, just make sure you use caution with these options, as they can seem like it's great, but it might end up being more expensive than you think. And beware of scams for credit repair. These are companies that promise to erase bad credit or remove credit that might be negative, but if it's accurate, they promise to do it fast and easy. They'll create a new identity for you. They want you to pay up front. They won't tell you about your rights. And so just keep in mind, you're not, even if you have negative credit, you can't remove it unless it falls off within that time period. And creating a new identity is not going to help you. That being said, protecting your credit history, there are important things like having a fraud alert. There are some active duty military alerts, extended fraud. Anytime someone steals your identity, it could be someone known or unknown. You can do credit freeze, you can do a credit lock. But also making sure as soon as you notice this, that you're alerting those agencies that there is something happening and that you are a victim of fraud. And moving to the next module, which is borrowing basics. And so this is talking about ways you can borrow money and what it costs and what it means. So a lender obviously provides you money and you have to pay it back, usually with interest. When we talk about credit, it means the ability to borrow money, and then debt is the money you owe a person or business. And so there's a lot of different types of loans. Installment loans are repaid in equal payments over a set period of time. Examples include fixed rate mortgages, auto loans, student loans. Another one I'd say is cell phone loans. Those are usually installment loans because it's the same amount every month. Revolving loans are repaid based on how much you've borrowed, and the examples are credit cards and home equity lines of credit. So what usually happens is you pay it and then you can keep borrowing, and so that's where it is revolving. And then these things called rent-to-own services, they're not considered a loan. It's when you use an item for a certain amount of time and then you make monthly or weekly rental payments. And they're usually partially credited towards the purchase price, but stores can take back the item if you miss payment. And so with these, a lot of times this might be like furniture or certain kinds of electronics. those might be rent to own. The other thing we talk about is buying things on layaway, also not a loan. Usually you have to put up some deposit and then you have a certain amount of payments over time, and the store holds the merchandise until you pay in full. And the important thing here is you need to make sure you understand the layaway plan, if there are any fees, and then the consequences of a late or missed payment. Like if you miss one payment, do you completely forfeit it, or how does that work? And then if there's any sort of refund policy. This is usually at stores, and I don't know how, it used to be more popular. I don't know how popular it is now, but it is, depending on where it is usually an option. And other ways you can borrow money and what it costs, there are secured and unsecured loans. Secured loans require collateral such as your house, your car, or cash, and you'll lose the collateral if you don't pay as agreed. Unsecured loans, there's no collateral. Often they have higher interest rates than secured loans because the secured loan obviously comes with this collateral. And in general, when borrowing, you have to repay more than what you borrowed. And the principal is the amount you borrowed, the interest, the amount of money the institution charges for allowing you to use it, and then fees. There are certain fees charged with, such as reviewing loans. If you're doing a mortgage, anyone who has bought a house knows there's a lot of fees involved. Another option is prepayment, which is early repayment of the entirety of a loan. It usually reduces the interest and pays off the loan. Or you can do an early repayment for just part of it. And again, it reduces the interest, and usually it can give you an earlier payoff date. Some loans will have something called a prepayment penalty or not. If you're considering this option, I would definitely make sure to check and see if there's any sort of prepayment penalty before you decide to pay it off, because financially it might not even make sense to do it if you have to pay more. So that being said, the Truth in Lending Act is, it was an act put together by Congress, and it's a written disclosure, and what it requires is that loan terms are shown in a clear and uniform manner. So no matter where you get the loan, they're always done in the same way. And I have an example of this over here on the right-hand side. And so usually they're helpful to compare loan officers, and you should use them, especially when you're looking at annual percentage rates to compare offers. And again, you can seek help anywhere. You can talk to a bank, you can talk to housing counseling agencies or credit counseling organizations if you want to help comparing them. But if you look, it obviously shows you what the annual percentage rate is, the finance charge, the amount financed, and then the total payments. So this gives you all the information. You can see, obviously, the total payments is the finance charge plus the amount financed. And the APR is how you get the finance charge. And as I said, these are consistent, so you can use it to compare when you're looking at different products and different offerings to see if they're similar. So when preparing to apply for a loan, you should make sure you're considering what lenders are looking for when deciding to loan money. And then you should also make sure you're prepared that you're going to be able to afford whatever you're doing. What a lender obviously will look at is your credit, character, your capacity, your capital, your collateral, as well as the condition. So your credit, character, how have you paid your bills of debt? This is, again, using your credit reports and scores to see how you pay credit in the past, how many credit cards you have, whether you've ever filed for bankruptcy, had property repossessed or foreclosure, and made late payments. Capacity is your present and future ability to meet your payments, how much of your income goes to pay debt, your debt to income ratio, how long you've been working, how much money you make each month, and then what your monthly expenses are. And capital is the value of your assets and your net worth. This is the amount of money you have in your bank accounts, your investments and other assets, and then your general net worth. In collateral, again, this is for secured loans, any assets you use to secure a loan, such as your house or money in a bank account. and then the conditions depends on the type of loan. And just wanted to note here, talking about co-borrowing or co-signing, is when co-borrowing is you take out a loan jointly with others. In this case, you have to repay the debt even if your co-borrowers do not. In co-signing, the loan proceeds go to the borrower, not the co-signer. The co-signer also promises to pay the debt if the borrower does not. So those are a couple of options. So borrowing when someone helps you manage your money, it's important that you understand this even if somebody else is helping you. The responsibilities, obviously, of the person helping you is to act in your best interest, manage your money and property carefully, keep your money and property separate from theirs, keep good records, and then make sure you're included in the decision making. So when doing this, what you should discuss is why you need to borrow money. Do you have enough money to repay a loan? How many payments? Will it affect your other sources of income? And then what's the best borrowing option for your needs? And if you do decide to borrow money, you can get help considering the terms, doing the application. The lender will decide, obviously, if you're a good credit risk. They won't consider the credit of the person helping you, but you should ask for help if you need it when remembering to make timely payments and, of course, keeping good records. So this module 9 is talking about using credit cards, so how credit cards work. I know we talked a little bit about it. What a credit card is again, it's a revolving line of debit. You can credit. It's a convenient way to buy goods and services. You buy now, you pay later. It limits how much you can borrow based on your credit limit or credit line. And you should at least pay a portion of the bill every cycle. So this is an important credit tool. Obviously, when building your credit, it can help you with emergencies. Obviously, it's convenient buying things online or over the phone. And you do have the right to dispute erroneous charges and then certain charges, obviously, for things that you didn't receive or didn't get them as they were agreed upon. Important to note, there are cards that aren't credit cards, charge cards, prepaid cards, or debit cards. Those aren't considered credit cards. And again, we talked a little bit about the truth in lending disclosure. This is really helpful when looking at credit cards because the rates and fees can vary greatly, and it's written, and creditors have to give it to prospective customers. So it contains all of the important rate and fee information. So it's really helpful for you if you are getting a lot of credit card offers or you're considering that you look at it to make sure you're comparing everything kind of apples to apples. And so rates and fees, the annual percentage rate, APR, cost of credit expresses yearly rate. There's a penalty APR if you don't pay on time, and then the interest rates if they're fixed and variable. And so one thing to keep an eye out for is a lot of credit cards have low introductory APRs, might be 0% for 15 months, but then it becomes a variable APR and it might be 15 or 25. So those are pretty high. With rewards, there's tons of rebates, points, miles. You should know how to qualify, understanding how to maintain them, and also make sure to you don't fall in the trap of you're trying to reach to a certain reward, and so you're overspending to get there. If you have to overspend just to get the reward, then it's not really worth the reward. But I know it can be tempting to say, oh, if I just have 5,000 more airline miles, I get a free ticket or whatever. So make sure you consider fees when you're looking at rewards, and again, shop around. There's tons of different websites that compare certain kinds of credit cards for different kinds of rewards, like airline cards. NerdWallet has a lot of comparisons. So if you are looking into something like that, those are really helpful tools to do those types of things. Also, when, just in general, when other important credit terms are your credit limit, maximum credit you can use. Each creditor has its own specific standards, so it might be slightly different. That they look at your credit history, your income, your outstanding debt. The grace period is the time between when your statement's issued and when your payment's due. And creditors, it's important to note, they don't have to give a grace period, but if they do give it, it should be in writing. The balance computation method how the interest on your account is calculated. There are a lot of different methods. And your cardholder agreement, it's like a little booklet. It'll come. It includes information, including what method is used. Average daily balance is one method, but there, it could be average daily balance. It could be weekly, it could be monthly. There's a bunch of different ways, but you should make sure, again, to read the fine print so you know. So other features, products, services, there are a bunch of different customer service features you can get through your card. There's extended warranty. You could also have payment protection or credit monitoring with a credit card, which is helpful. Again, they're unsecured and secured credit cards. Unsecured don't require collateral, obviously, but secured credit cards require collateral. And so this might mean you have a dedicated bank account and it's linked directly to that. This is a good tool if you are looking to build your credit and you have a secured credit card, because if you pay the balance regularly on the due date, it'll show this kind of credit history because it's coming out of the account. And then this again will help you qualify for unsecured credit cards. Obviously, if a secured credit card, it usually has a lower credit limit, but sometimes people apply for these first if they can't get unsecured credit cards. And as I said, it can help you build your credit history. And when applying for a credit card, obviously there are lots of options. You can go through a bank, you can go through a store. As I said, there's lots of websites where you can you can compare them. You can get things in the mail. You can also opt out if you are tired of getting the offers. There's the phone number and also this optoutprescreen.com. So just make sure if you are getting too many offers and maybe you feel tempted, make sure to call or go to that website so you can make sure they stop contacting you so you don't see them anymore. And some of these key terms, if you are applying: credit card applicant, creditor, individual credit, joint credit, authorized user. The applicant is obviously whoever is applying. The creditor is who's providing you the card. Individual credit is if you're applying by yourself, it's your credit. Or if you're applying joint credit with somebody else, the individual credit will be for one person, joint credit is both of them together. And then another thing is you can apply for a credit card and add an authorized user. You might add a spouse or partner, someone else to your card as well. And then they'll get a card in their name to the joint account.
Abby, can I ask a question? I was on my husband's credit card and I came off. So would that affect my credit?
Do you know if you were just a user?
Yes, I was just a user.
I think if you're just an authorized user, it's not against your credit. But if you had applied like joint credit together, then it would count against your credit. Does that make sense? Yes.
I think I was just a user, so that's good. Thank you.
Yeah, you're welcome. But again, what's great is, let's say you weren't sure, that would be a really good example where when you run your credit report, you can then double check, because if it did show up on your credit report, then you would know that that is something that's on there. But I would imagine, like in this example, if you ran it and you saw it on there and you could see like this, your ex-husband's running up a balance, like that shouldn't be showing up on your credit report. But that's a good way to double check.
Right, I will. Thank you. That's great.
Welcome. So just kind of talking about managing your credit card. Credit cards obviously can be convenient, but you need to manage them carefully to keep costs down and avoid damage to your credit. There are a bunch of items on the credit card statement: credit counseling, notice of interest rate charges, transactions account activity, transactions finance charges, annual fee, any of this stuff, the interest charge, and your interest total. And steps to manage your credit card, again, can't say this enough: keeping good records, checking your statements for mistakes, they do happen, paying on time and at least the minimum. Make sure you understand the impact of different payment strategies. try to limit what you owe compared to your credit limit. You obviously don't want to be really close to your credit limit, so you have some space, and see how payments are applied to your balance. If you pay just the minimum payment, the creditor can choose how to apply the balance, and they'll obviously apply it to the part with the lowest interest rate so that you continue to get the highest interest rate. But if you pay over the minimum payment, then it's applied to the part of the balance which has the highest interest rate, which is what you would want to be paying off because the interest rate is higher. So I have an example here just showing like paying the minimum versus paying more than the minimum. So here you can see this has a bunch of different items: TV, repair, or furniture. You can see the APR is 18%. And you bought it for $500, you paid $132. It takes you 3 years to pay it off. If you buy something for $1,000, you pay $863, it takes you 8 years. And then the furniture is $2,500. It takes you 23 years. So that being said, with the 18% APR, and this is if you're just paying the minimum, that would take you 23 years, but if you pay just $24 more, it takes 4 years to pay off. And if you just pay $41 more, it takes you 3 years to pay off. And so you can see you pay a lot less interest, and the overall amount that you end up paying is so much less. So moving on to the next module, which is building your financial future. This is based on assets and asset building. And assets can obviously lead to wealth and financial security. And what an asset is something you own that has value. There are 3 types: physical, financial, productive. And the value is obviously determined based on the type of asset. The benefits of asset building, obviously, financial security, foundation for your future, and they're essential to kind of long-term stability and growing wealth. And owning assets helps you create a buffer for emergencies, helps you reach your goals. It gives you different options. It can help you earn more money, more income. It helps you to look for the future, and it reduces your stress. So how assets create a financial foundation. I mentioned this a little earlier. Net worth is a good measure of your financial stability. You can see net worth is your assets minus your liabilities. And as I said, an asset is anything you own that has value. A liability is something you owe others, usually money, and equity is the value of the asset minus the liability related to that asset. And anytime you have a positive net worth, you know you have a financial cushion. If you have a 0 or a negative net worth, you don't have a financial cushion. And then again, the way you calculate it is you can list all of your assets to come up with your assets, listing all your liabilities, and then you do the subtraction. And again, with this, if anybody needs any help for this, I do have worksheets and different things we can download if you want different sheets that help you look at how to track your assets and your liabilities. So I'm happy to share that info if anybody needs it. So here's an example of creating a financial foundation. So this is Justine. So she bought her home 7 years ago. Current value of her home is $130,000. She still owes $100,000, so she's paid off $30,000. She has $1,500 in her checking account and $500 in her savings. She has a truck she bought a few years ago. She could sell it for $2,000. She owes $3,000 on the loan. She has a credit card with a balance of $1,000 and a student loan with a balance of $15,000. She has some furniture and heirlooms that are estimated at $7,000. So her total assets are $141 because it's her home, plus her heirlooms, plus her truck, plus her accounts. And then the liabilities, again, are the loan she has on the truck, the amount she still has on her mortgage, and the credit card and the student loan balance. So you can see her net worth when she subtracts everything from it is $22,000. So how to change your net worth, obviously increasing your assets or decreasing your liabilities or doing both. A couple ways you can do it is spend less than you make, buy less than you can afford, save money. Using employer programs, what this means is, for instance, if your employer has some sort of like 401k match, some sort of matching program, using that, using your debt responsibly, paying down your debt, seeing if there are any public benefits you can use, claiming tax credits, and then shopping around and obviously building more assets. And one example is cars can be assets. They can be predictable. Obviously, they provide some level of financial security, and then they can increase your access to jobs or certain medical services, education, childcare, or elder care. And how much car, there's no precise formula to figure out how much you can afford, but there are guidelines and questions that can help. Remember your savings and spending plan, and then always make sure that you're including costs. Sometimes they're hidden costs. People don't think about insurance, maintenance, gas, any title and registration fees, excise tax, those type of things. When getting a car loan, of course, looking at your credit report, you can get pre-approved for a loan. Make sure you shop around, and you can keep records of your loan quotes. And obviously leave the car at the dealership until the loan is final. So you shouldn't pick it up until you have finalized the financials. And another way you can help build assets is through training and education. It can lead to higher wages. It can help be a part of your strategy and a smart investment towards meeting goals. Sometimes they lead to higher pay and good careers. There are types of educational experiences, institutions you can do on the job training, apprenticeships, vocational or career and technical schools, any sort of colleges, joining the military, any sort of the Job Corps. And it is important to remember, though, when pursuing education and training, you might need to invest your own resources, such as time and money. You may need student loans. And you do have to think about the opportunity of the opportunity cost, in that the time you're spending in school is time you're not earning money. And so sometimes training or education isn't always the best bet for investment. It depends on the program, the amount of time, how much it takes. An example could be, I know when I was working, I know some people who back then it was really popular to go get an MBA and do it full time. But then if you're doing that, you're not making money. So another option you can do is, say, do a part-time program, and your employer might help pay for it. And then you can still continue to build your wage base. So those are different options. So there might be different ways that you can kind of do something part-time so that you don't necessarily have to forego your wages. There are ways to pay, asking for help. You can saving money. You can work while attending school, applying for scholarships and grants, asking for help from your employer, of course, and then borrowing money in any combination. And when looking at scholarships and grants, these are tough. They are merit-based. They're based on certain qualities. They're very competitive. Most grants are need-based, and they can also be competitive, but they might be more based on your financial situation. And there are different ways you can save money. 529 plans, which are specifically for education costs, ABLE plans, which are for any individuals with disabilities who use the funds for education. Student loans, you can get private or federal loans, depending on who's the servicer. Usually the repayment starts after you leave school. Usually federal loans have lower interest rates. There is the FAFSA, where you can apply for student aid. You can see, you can go through the app. And again, you should check with how much student aid you'll qualify for. It all depends based on your situation. And with student loans, very important to pay them back on time. Federal student loans aren't automatically discharged by bankruptcy, and non-payment can result in being referred to a debt collection agency, your credit score, and wages withheld, but also make sure before you're going to get a student loan, you understand the terms and what you need to do to repay it. And if you talk directly to your loan servicer, you might be able to restructure your payments, or you might be able to find out more. And so this studentaid.gov is a helpful website for any of that information. Our last module is protecting your identity and other assets. I'm just going to give a little bit of an overview about identity fraud, so we understand a little bit about this. But there are risks to your assets. And so obviously the assets, what you have that's value, and then the risk is the potential for harm. Obviously you can't eliminate all risks, but you can reduce them, making sure you're informed about your choices and you can anticipate any of the risks. And then, of course, being careful with your personal information, knowing your rights, and getting insurance are all really important when making sure to protect your assets. That being said, identity theft and fraud, your identity is one of the most important assets. And the identity theft is when somebody uses your identifying information without authority. And your identity is who you are, and you have documentation that proves who you are, but information thieves can use it to impersonate anyone. And there's a lot of crazy ways people can steal your identity. A lot of these, I don't know if you've heard them. Phishing is when people trick you into giving information through email. Vishing is phishing, but doing it over the phone. Mishing is phishing, but on text. Spear phishing is targeted phishing. There's farming, fake websites where you think you're putting information into a legitimate website, but it's really just a kind of copycat. Skimming is stealing credit card or debit card information. And then social media scamming is this is popular through, could be Snapchat, Instagram, Facebook, any of those where someone makes up a fake identity to try and talk to you and befriend you, and then they want to steal your identity. And so there are ways to minimize identity theft, obviously guarding information, don't respond to unsolicited requests, protecting your mail, using direct deposit so you're not using paper checks, cleaning up your financial trash, making sure you shred things, reviewing your credit accounts regularly, checking your credit report, being aware of identity theft on the internet, so protecting your devices. I already mentioned the credit report, making sure you keep all documentation secure, and reading scam alerts, and beware of disaster-related scams. I know lately that was a way that unfortunately people take advantage of a terrible situation where you might be trying to do the right thing, you want to donate to a good cause, and people steal money that way. So making sure that if you are ever donating to an organization, make sure that you know who the organization is and that you vet it before you're going to give them your information. That being said, there are a couple of warning signs about identity theft. There might be withdrawals you didn't make, missing bills and statements, people refusing your checks or credit card transactions. You might get letters or emails about accounts you didn't open or purchases you didn't make, or you might receive statements for cards you don't have, and debt collectors calling about debts that aren't yours, or passwords or usernames not working. So those are a couple signs that if that happens, beware. So that being said, if it happens to you, you should report it immediately and get help. You can create an identity theft report. This is an example of it. You can go to identitytheft.gov for more information, but this report, you can fill it out, and it provides all the information to government organizations, government agencies. So you can work with the credit reporting agencies to respond to the theft. You can place a fraud alert on your credit reports. I mentioned before you can do like a credit freeze and a credit lock. You can dispute inaccurate information. As I said, the credit freeze is free. You can obviously communicate with your creditors and debt collectors, let them know that there's fraudulent account, someone's trying to steal your identity. You can get copies of the documents, ask them to stop contacting you about fake accounts, and then you can also get written information about fake accounts. You also do have other federal rights. As I said, go to identitytheft.gov. You usually don't have to pay for fraudulent debt or accounts caused by identity theft. And in terms of a data breach, if, you know, I know people have heard a lot about them, like Target had one, there's different ones like that. You can go to usa.gov and it can tell you about your rights. But usually you'll have, again, you might have right to have another access credit report. You might have right to some sort of credit monitoring program, different things like that, so that you can make sure that your identity is protected. So knowing your rights is really important in this situation. Another important tool is insurance and record keeping. Insurance obviously protects you from financial loss, and keeping accurate records helps you when there's any damages. And the insurance, how it works is it reduces the impact of the loss by obviously having whatever covered with the policy, and it helps you protect from catastrophe. And so some of the key terms are the premium, the covered loss, the coverage limit, the deductible, your co-payment, your co-insurance, exceptions or exclusions, claims, and adjudication. So the premium is what you pay. The covered loss is whatever you're paying to cover that if anything happens to it, you'll be reimbursed. There might be a limit to how much they can cover. The deductible would be you might have to pay out of pocket first before they will cover the rest. Co-payment is, again, if you have to pay a certain amount of money as a payment. And co-insurance is you might have to have multiple types of insurance. There can be exceptions or exclusions to anything. A claim is if something happens to whatever you're protecting. And then adjudication is however your claim is being resolved. And so types of insurance: health care, long-term care, dental, vision, disability, life, pet insurance, identity theft insurance, vehicle insurance, renter's insurance, homeowner, flood, all sorts of insurance. And how to get it, it depends on your circumstances. It can help you manage risk to your assets, and you can consider it for things that could happen that would cause serious harm. Some insurance is required by law. For instance, car insurance is required, homeowners insurance, I think, is required. Sometimes if you're renting, you have renter's insurance. So what you should make sure, though, to do is review your coverage and shop around. Sometimes if you bundle insurance, you get discounts. There's state-specific requirements. You can get different quotes. You can consider the trade-off, like changing your deductible, the coverage limit, your premium, the co-insurance. And again, can't stress it enough. Make sure you keep accurate records. So you make sure that your insurance is covering what you want, and then that you have an accurate list of your assets. And if any damages or anything happens, that you know, and obviously file claims as soon as you can. The sooner the better. And that's it. So I know it's pretty fast and there's a lot of information. I don't know if anybody has any other questions.
Yes, I do, Abby. Hello.
Yes.
This is Diane. Hi. I wondered if we could get copies of those modules, the ones that came up on the screen.
We can. So I think Janet has the link. She'll send it out, but all the information is free, and it's at this website called fdic.gov, and you can get all the modules. And they also have, when you look in the module, it has like the slides I'm doing, but there's something called a participant guide. And so that you can kind of go through. I had sent her some for the last one. I can send them over individually, or if you want, we could just send you to the website. Whatever's easiest.
Yeah, I can go to the website, fdic.gov.
Here.
And I can.
Yeah, I'm gonna put it in the chat right now. Hold on.
Yeah, and I can send the slides from tonight to everyone who signed up.
Oh, that'd be great.
And then, yeah, and Abby just put the link in there that we'll show, you'll go and you'll see all the links and all the modules, and you can kind of drill down.
Okay.
Yeah. I do, because just to warn you, the modules can be pretty intense. That's why I try to like distill them down a little bit. By all means, have at it, but there is a lot of helpful information, especially the participant guides I mentioned. If you're, you know, creating a savings plan, or you want to work on tracking your assets, things like that, those can be helpful for that. But it's just, at the website, it's a lot of information, so don't feel overwhelmed when you go.
Well, I'll start with the ones that you're sending that you had tonight.
Okay, yeah, no, right, because I tried to pull out the most valuable information, and I do have the websites and links in there as well. But yeah, there's a lot of great information, whether it's with the FDIC, but I'm happy to send over anything else. As I said, I think we had sent over a couple of worksheets. If anybody is interested, we can pull those out too.
Great. Okay, thank you.
You're welcome. Any other questions? Okay, well, if that's it, thank you everybody for coming. As I said, next week we're going to talk about managing debt and the home ownership modules. So feel free to drop by if that's something you're interested in. And thank you again for attending and listening. Very happy to have you here. And feel free to listen if you want. This is recorded. Again, you can ask me any questions. I'm happy to help. So thanks again, everybody, and have a great rest of your evening.
You've been amazing. I just have one question. Do you have any recommendations, or can you send anything along for those of us who are trying to protect teenagers?
So that's actually, I do, and this is one of the things this is the Money Smart for adults. We also do have a version of it, which we do for young adults.
Great.
So teenagers. Great. And so if people are interested, we can share that with young adults.
Fabulous.
If people think it's valuable.
Fabulous. Thank you so much. This was terrific. Appreciate it.
Yeah. And I just put my email in here. If anybody has any questions, you can always just shoot me an email as well. It's in the chat.
Super.
Thank you, Abby.
Thank you so much.
Great. Thank you, everybody. See you next week.